Hello, folks. Brandon Chapman with you today. It's another Theo and I video for Thursday. What is it, February 23rd? Are we that close to being the end of February? Pretty crazy to think about how fast this year has blown by. And yet, what has the market really done for the year? Year to date, we were up, probably 38.45 to 4,000. We had one of the best Januaries. February so far has really kind of lagged as we're down slightly for the quarter or for the month. The question is, where do we go from here? Today's title, Nvidia earnings pop helps tech lead and the S&P hold the line. This level around 4,000 is a key level. Why is it key? Well, every 100-point increment on the S&P, I guess, is technically key. But if we look at kind of an area of resistance, recent kind of support here, resistance there. Yesterday, kind of towing the line at 4,000, holding it again today. I mean, it looked like we were poised to break through and start to trade lower down to the next level, which is 3,900, and then maybe the next level at 3,800. The point of this is that we're not trying to estimate, well, what's the probability 4,000 holds? The reality is 4,000 can break. It's not so much what the probability is, it's just that if it does break, where's the next level? What does that tell you about the broader market? And as we look at the rally, since the beginning of the year, and I drop kind of a fib retracement starting at the beginning of the trend to the end of the trend here, we're at about a 50% retracement mark. If we break this and go to 3,900, it really begins to open the door to retesting prior lows at 3,800. But what buoyed the market today was Nvidia's 14%. Now, in and of itself, does it hold the market up? No. But it does reflect something. And as you see the leadership in technology, this is ultimately, if the market's going to push higher, technology and cyclicals have to kind of come around. Now, there may be some difficulty, Walmart's not necessarily part of cyclicals, but Walmart's had a difficult time following its earnings. If you've seen Home Depot, the bottom fall out of that, there is real concern about the retail, the retail, not just the investor, but the retail industry and consumption. We've got Macy's coming up here on the 2nd of March. So far this quarter, with over probably close to 450 plus S&P 500 stocks reporting, about 70% have beat earnings and 71% have beat revenues. But this back half, right, as we're entering into March, when we're going to have a lot of retail-oriented companies, this is where we start to see what's the consumer, what's the state of the consumer. Is the consumer starting to lag or pull back? Now, this is representative of the first quarter. Certainly for us, second quarter, we're talking January and, fourth quarter and first quarter. January retail sales have been better. Personal consumption expenditures have been better. So again, what is the outlook here? And again, looking at Home Depot and Walmart, frankly, the expectation or the guidance from Walmart, despite the fact that it had decent earnings, was not fantastic. And so what do we learn from all of this? Again, there is serious risks to the downside in the broader market. The only question is a matter of how long can we allay those concerns and be able to operate in a bullish fashion, allowing prices to rise. I don't think that's going to be around very, very much longer. I think as we progress and we start to get into March, April, May, we're going to start to see the impact of the Fed's first rate increases a year ago. Because again, they've raised 4.5% in less than a year. That's very, very significant and historic. And generally speaking, it hasn't boded well. But those moves in interest rates generally lag for about a year. So far, in that fourth quarter, revenues have largely done better than expected. Revenues up 5%, while earnings are down 5%. Ex energy earnings are down nearly 10%. On revenues, just shy of a 5% increase. So we're seeing margins get compressed right now with higher revenues and lower earnings. When do we start to see revenues begin to turn? And is some of the guidance that we're seeing from Walmart, Home Depot, and others, is that starting to indicate maybe we're starting to slow? And we'll see what happens. But as of right now, the market is poised at this level around 4,000 to catch a rally. We were kind of in a mode of consolidation up here. And it's like, okay, who blinks first? Do we break out, go to 43? Or do we pull back 4,000, 39, 38, find support and rally? The last 2 days certainly is encouraging for the thought that we may catch a bid here and rally back up to 4,200. Now, for those that are members of TheoTrade, you would have gotten this alert, but Don sent out an inflection point spread yesterday, basically trying to not that he's trying to time the VIX, but trying to see the VIX rose pretty significantly, and there was an opportunity there to sell some premium with the VIX at around 24, and we have what's a strategy called the inflection point spread, and what that entails on a product like, for example, MES. This is the S&P 500 micro E-mini futures. The idea is, you could potentially sell here a 4,600 call and sell a 3,175 put down there. Very, very high probability of success. That may go for around $28, times 5, since we're talking about the E-minis, ties up maybe, $600 in margin. So you can really trade these kinds of strategies with relatively small accounts, but we always do it in a hedged fashion. We always sell puts in a hedged fashion, buying a 38.70 down here and a 37.80 rather, 38.80, 37.80 down here, long put vertical as a hedge in case the market declines. So if we decline further, it starts to get inside the inside hedge here. You're able to shut down the inflection point spread, typically at a small profit, or we start to rise here and those puts are taken off. You close out your inside hedge and you've got your 4,600 call. And then as we continue to rise more sharply, you may have a chance of selling a 4,700 or 4,800 and layering it in and collecting premium. And then we start to run up again, a chance to put on another inflection point spread to capitalize if the market declines. And so this is kind of that high probability premium selling approach. That's what worked really, really well over the last year. And certainly, the fact that the VIX is where it is, still north of 20%, this is kind of a premium seller's dream. And skew has even begun to rise at 122. And yesterday was kind of an anomalous day where the VIX spiked a little bit. Skew actually increased to 124. So we are seeing a little more hedging activity enter the picture right now with the skew at 122. We're still not at levels that indicates the fact that we're really concerned about the downside risk. And right now, as you look at the VIX is kind of coming off a little bit of a higher level. And another way to look at this is by looking at a ratio of the VIX3M plus VIX ratio. And you can bring up a pairs ratio study. So we didn't quite get to 1 or below, but we were at about 101 earlier today. We've kind of come up here a little bit. But what this suggests is that this is an area that's very low down here that says, look, there's not much expectation that volatility is going to rise in the near future. And it's not as positive as when you get down here, like we did, for example, in late September or end of April or early March or mid-June. We're not at those kind of levels, but we're close. And so there's not much pricing in the market right now by institutions that are using these products to hedge. There's not much expectation that as of right now, there's a lot of concern for much downside in the market. So when we reflect on the cash session today, there was a significant print back here at 399. We kind of held that on Tuesday and yesterday, and today we rallied off of a point below that, helping to solidify this. And maybe we're poised right now to see a run, retesting prior highs, maybe even lower. Yesterday in our at the close, it's an hour-long broadcast we do after the close on Wednesday. I was on with Professor Bierman, and he was kind of pointing to me, expecting a bounce, looking at 4,100 or 410 on the SPY as kind of that short-term upside. And so again, we're kind of in a mode right now where it looks like the last few days does point to the fact that maybe we're itching to rise right now. And again, you look at the orientation of S&P 100 companies, Nvidia, Oracle, Qualcomm. You can see just a lot of technology-oriented companies in that mix. Some industrial technology type companies. You've got some Mercs in there as well. For example, AMT, which announced their earnings today. Again, price is down, which for a REIT means their dividend yield is up. This company doesn't pay a lot of yield, but 3% on a pretty low leveraged REIT is not terrible. These guys are in kind of the cell phone tower business. But again, this is kind of interesting as we're testing the lows. Earnings came out. We didn't really fold, We may be setting up to rally, but we're seeing a 3% yield again for AMT, which is typically not a terrible time to consider a company like this going back over the last few years. This has been an area people frequently will step in and begin to buy a stock like this. Now, I didn't really have this one on my list, but let's take a look at a few stocks that I do after we look at just kind of the market more generally. Oil prices today did not really see any sort of rebound, and yet, what we did see is energy was the second best performing sector. I have a list of magic formula stocks. These are companies that are trading at a value based upon earnings yield and EBIT to EV, also higher return on capital. And these are some of the better performing stocks today. Coterra Energy on its earnings kind of making a play, gapping higher. You typically, if earnings happen, you want to see a company beating earnings, beating revenues, raising guidance. Medifast was up 5.5% today. One of the areas I'm kind of looking at right now is food companies, like in USFD, for example, which did pull back today, which is good. Maybe setting up support at 38. Even agricultural companies like Nutrien, Mosaic is on my list over here. Maybe on the cusp of breaking out following its earnings. ADM is one that's maybe starting to firm up down here. So again, some of these food-oriented companies and agriculture is kind of an area that I'm kind of looking at. Seriously, is maybe finding some degree of support as we move into the spring. And but again, energy did pretty dang well today, despite the fact that, again, prices are down, prices aren't rising, but they're high enough so they can make money. And so that's kind of what we're seeing right now, again, with Matson as well. So the fact is, when you look at CL and you see that we're north of 65, this allows these companies to make money, these energy companies, to make money even on new production. So they're able to expand production with prices around 70 and above, 65 and above. And so the fact that we're holding here is important, and these companies are able to get a bounce or a nice little gap on the earnings that occurred for a lot of these companies today. So they're getting a nice boost today and helping to lift the energy sector generally. All right, let's look at a few companies. One of the companies that I reviewed last Friday was BTU. And BTU had its earnings. We had a nice little kind of gap up. We sold off. We rallied. We finished at the high of the session. It's kind of looking for this thing to retest 29, but it broke through, and we saw a big drop on Tuesday. And we're kind of holding at the line down here to about 25.5. So with a positive earnings reaction and the pullback we're seeing right now, is it poised to maybe retest this prior high at around 30? Well, that's kind of what we're kind of exploring here. And that's what we're talking about. I thought last week we'd have a chance if we close near the high, maybe a retest and a bounce, running and testing 33. But today on the pullback, what you saw in the option market, and this was for a 3 March expiration. And there's more stuff that kind of filtered in later, but you'll see a 27.5 and a 30.5 here, 5,000 contracts, 5,200 roughly, buying the 27.5, selling the 30.5. And as you look at the price in here, 27.5 and 30.5, that's basically pricing in some expectation. Someone's taking a trade. They think that we're going to retest prior high at 30.5. So this is a nice kind of swing setup here with the price testing recent support. We didn't exactly close above yesterday's high, but certainly we're kind of in the mode where we could see a rally and a retest of the prior high near 30.5. And when you look at a trade like this, I guess we just look at the pricing right here, but we're talking about 46 cents, 7 cents, costing you maybe 40 cents to place on what? On a $3 wide spread, 27.5 to 30.5. That's a very strong reward to risk. You don't have to win a lot on this kind of trade, and you may consider actually going out maybe a little bit longer out to a 17 March, and you still have the same strike prices, 27.5 and 30.5. Maybe it costs you closer to 70 cents or so, but the reward to risk is still very favorable if we just catch a bounce and a run towards 30, or it could be a potential stock trade there. Another one's kind of interesting that's kind of using option spreads to set targets. Another one's here for ARK. It looked like we were poised to rally last week. I talked about this last Wednesday, saying, hey, if the market rallies, and which we didn't, we faltered, right? We pulled back. But there was an upside trade up here that was pretty cheap on ARK. But now we're kind of rolling back to support. We gapped up, we faded today, weaker than the market generally. We have a nice level down here at 38.50 that if we were to break below, may confirm the reversal. But sometimes it pays to put this stuff on early. If you notice, we're kind of at the 38% retracement level. We could reasonably, based on the strength of the sell-off here, roll back to 36. And we start to break this area, we're really looking at opening up that $30 level, which is the 223 to 261% projection off of this initial sell-off. And so we have the technical pattern that says 30 is potentially a potential target here in the coming weeks to months. And then you get the trade today, a rather sizable trade. And this is for the April expiration. And these things aren't hard to identify if you have a search, but the idea is buying the 36, 32,000, 30,000 contracts. Sorry, what I can't remember what it was, 31,000 something. And selling the 30, a 6-point spread. Right now, maybe costs you about $1.30. So you got $1.30 of risk, potentially a $4.70 of upside. So it's a very high reward, low risk trade, low probability trade. But look what it's doing. It's buying the 36, selling the 30, basically saying, look, they're wanting to capture, 36.30, wanting to capture this area down here by the April's expiration. So I like this setup. Again, you may not like the idea that it's a low probability trade because we really got to see a breakdown to even get in the money, but you'll break even quickly here at about 34.70, and then you got all the upside down to 30 by April's expiration. There's plenty of time for this to happen. The fact of the matter is we may see a stronger dollar. The Fed's now potentially may push to 5.25%, 5.5%. We're seeing some pricing to that effect. And what does this mean as we go into the spring? And if we just bob along here for a little while, you could potentially roll that 36.30 spread out to another month or two without a whole lot of cost. So again, just a thought here, trying to capture the downside on ARK, testing the lower level down here, 36.30, and you don't need it to break out right away, okay? So again, you can start to layer in some of these thoughts. I got another one here to share as well, and that is EEM. So EEM's been down a lot recently, weakness in the Chinese market. There's a lot of Chinese stocks represented in the emerging market fund. We've had a stronger dollar, and we may see the dollar ease back here in the near term. We may see this rise. But as we approach the spring, April, May, what do you expect in terms of where emerging markets may be? When things are kind of oversold like this and we're in the hole, generally it's not nice to short in the hole. But one way to do that is by buying out of the money spreads, risking a little to make a lot, given a low probability. This would be a better setup if we rally to 42. You could wait to see when this comes in. But today there was a rather significant trade in emerging markets for this April expiration, buying the 38 and selling the 35. And again, you look at this scenario here, right? 38 is right here. 35 is near support here. Again, the notion that we're saying, look, we may catch a little bid. We got plenty of time for this thing to roll over. And the expectations, we break below 38. And again, we're in the mode of retesting the October low for EEM. This is going to take a pretty decent sized move in the dollar, as well as weakness in the Chinese markets. But again, after maybe a little pop here, we could see a rollover, or we just see things roll down. Again, the near-term posture of the S&P looks like we may have a chance of bouncing here. So you could wait to see and keep those same strikes or move your strikes up a little higher. But again, this is set out here for an April timeframe. And I think this is a trade that could be mirrored. Remember, you got a position size around max loss because this is a low probability trade to get below 35. But the reward may be worth the risk. And certainly the skew is favorable because you're buying the lower implied volatility option and selling the higher implied volatility option, meaning that there's some juice in those options to reduce your net cost. Finally, I'm going to wrap it up here with Blackstone, BX, the stock that everyone loves to hate. Anyway, we're kind of at support right now. We're seeing lower highs. This trigger level right about 89.50. We start to break this. We are looking at a retracement, and we did have an earnings that came out that we've already kind of played out the rally following the earnings. But if we see things begin to turn, could we see 83.30, which happens to be historical level support? Could we see it roll back to 70? All things are certainly on the table here. And today's trade in Blackstone, If we go to the trade tab, and we look at the 31 March expiration in here, you'll see in here buying an 85, selling a 75. So somebody's taking a pretty big downside bet that we are going to retest prior support. So 3 different products, all looking at the same thing, basically testing their most recent lows, whether it's October or December. And this provides a way to provide a degree of speculation. Low risk, high reward, low probability, but you don't have to be right very often if the price gets into this area. So a few different opportunities, very similar. And then we've got the bullish side with BTU, maybe getting a swing off of support to recent resistance, but showing how these trades are kind of basing on the technicals, using the strike prices to set in how they're choosing, using the technicals to help set which strike prices that they're choosing. And of course, the expiration reflects the outlook. Well, folks, we're going to wrap it up there. We'll catch you back next week for next Thursday's video. You have a great one. Thank you.